Good afternoon, everyone. Welcome to our MQ Trader webinar on the topic of Elliott Wave Analysis. I'm Casey, the host for today's event, and also one of the MQ Trader team. So before I start, can I have a quick mic check? Can all of you type 1 in the chat box if you can hear me clearly? And while waiting for your response, remember to log into your MQ Trader account or sign up for an MQ Trader account so that you can use the chat box to chat with us and interact with us. So remember to type 1. Just have a quick mic check. Great, I see a lot of you responding. Thank you for your response and continue to use the chat box to interact with our speaker throughout the webinar. Okay, so let me start with a brief introduction about MQ Trader. MQ Trader stands for Malaysia Quantitative Trader Group. We use quantitative methods to do our trading analysis, and we've compiled all these methods into our MQ Trader stock analysis tool. This tool is made available to all our MQ members for free as we seek to empower all MQ members to make quicker decisions and with greater confidence with this tool. So here's our subscription services available in MQ Trader system. So we have the stock analysis tool. We also have MQ affiliate program. We have MQ Dummy, which is what we are using now, and also MQ event, where you can check out up-to-date information about financial events around you. So if you want to know more about all our system, you can take a screenshot of this screen and you can refer it later on. And with MQ Trader, there's additional account opening rewards, including free account opening fees, which is waived. And then you also have MQ Trader t-shirt after the 5 trades you perform in your new account. You can also get free share transfer and also i3 investor portfolio integration for free as well. Again, if you're interested to open a trading account with our selected advertiser, feel free to scan the QR code on the screen. We have M Equities LYH team and also TA Securities Jessie Xiao. Okay, and also we are running a MQ referral campaign in 2023 where you can get, all our MQ affiliates can get bonus of 1,000 MQ coins for each successful referrals. 1,000 MQ coins is equivalent to RM10 ringgit. So if you're interested, do sign up to be our MQ affiliate and also do start to refer now before the campaign ends at 30th of June. And for all our MQ members, remember to claim your check-in rewards where you can get a bonus of 300 MQ points. So you just need to do, what you need to do is to just screenshot any part of this webinar and then submit the screenshot into the post-webinar quiz that will be sent to you after the webinar ends. So if you want to get the post-webinar quiz, remember to register for the webinar itself. You can get the QR code on the screen. And before you forget, you can take the screenshot now. I'll wait for you for about a few seconds. Just in case you've forgotten about it, this screenshot is important for your check-in rewards. Done, everyone? Okay, so today's webinar is sponsored by VC Plus. VC Plus is a global online trading platform where you can trade stock index options, foreign exchange options, commodity options, and etc. They support various payment methods. They are also registered with authorities around the world. You can access 2 platforms with 1 account with VC Plus. The account opening is free and it's totally online. So if you're interested, you can scan a QR code on the screen itself. And here's a showcase of their chart where you can get the signals within just a few clicks and also even backtest the signals as well. Backtest is to test the accuracy of the signals. So these are free for a VC Plus chart. And if you're interested, they are also running a welcome credit campaign where you can get USD 100 when you deposit at least a 500 USD into your new VC Plus account. So terms and conditions apply. The campaign ends on the 30th of June, 2023. So if you're interested, remember to scan a QR code to open the free trading account with VC Plus. And if you're interested to know more about their daily market updates, you can scan the QR code here to PM them to add you to the specific chat group they have in MQ chat. Remember to PM them, add me, or just ask them to add you into the group chat. And we will be having a Q&A sessions with Ka-Yong after his sharing. After the Q&A, so remember to send in any of your questions throughout the webinar and we'll compile them and send them to Ka-Yong during the Q&A session. And followed by the Q&A session, after the Q&A session, we will have a mysterious gifts. Okay, so we will be giving out gifts worth up to 249 ringgit. So make sure you stay till the end so that you can grab your chance to win our gifts. And like what I've mentioned just now, Ka-Yong is our speaker today. He started his trading journey with 500 USD when he was 21 years old, and he managed to turn it into 13,000 USD within 2 years. He was then featured in CNA Money Mind in Singapore when he was 23. So along the way, he was also awarded the most popular FX trainers in Malaysia and the top Forex analyst in Asia. So he is currently a market analyst on various platforms and also a head coach in eSmart Academy. Today, the topic that he will be covering is about Elliott Wave, which he will be explaining about impulse and corrections and the building blocks of Elliott Wave Analysis, and also how to determine your directional bias so that you can use to forecast the future market movement. So after all this introduction, can I check if you're ready for Ka-Yong's sharing? Can you type ready in the chat box? Remember to sign in to your MQ Trader account so that you can interact with us. And also send us your inquiries throughout the webinar. So are you ready? Jiajing, yes, thank you for the first to respond. Chen, Git. Okay, since I believe all of you are ready now, so let us invite Ka-Yong up to share with us now. Ka-Yong, I'll pass the time to you.
All right, Kay, good afternoon. So good, just quick check just to make sure everything is running. You guys can see my screen and hear my audio clear, right? If you can just type OK in the chat so that I know, then we'll start. All right, good. So I see Muhammad Soy says OK. So I believe everyone should be able to do that, okay? So great. So today's topic over here would be a quick one in terms of understanding the Elliott Wave Analysis. Okay, this is by far to me right now one of the most effective technical analysis methodology to do what we call a forecasting aspect, right? So forecasting, in short, is really about preparing the various scenarios that can potentially happen in the future, so that as a trader or even as an investor, you're always prepared and you're not going to be thrown into a surprise whenever the market does something, right? So you can't have in mind what can potentially happen, and then you plan for those scenarios, and then you take action whenever a scenario can fulfill your criteria and your conditions. Okay, so today we're gonna go into what I call the essence of Elliott Wave, the foundation of it. Because if today you want to really learn more about Elliott Wave, you want to start acquiring it, definitely it's not gonna be able to cover in a single webinar like that. Okay, so today's objective is to really establish a very strong foundation so that if you'd like to take this to the next level, based on Elliott Wave, you would have what we call the starting point, right? To build up onto Elliott Wave Analysis itself. Okay, so quick one over here as well, a little bit about myself for those of you who are first time joining in for a sharing session that I'm doing. My name is Kayong. So I started trading back in 2012, and to date, we can say it's 10 years. In my whole journey, of course, I've come across many different methods here and there, technical analysis, fundamental analysis, the various forms of it. And of course, my style shift, right? From time to time. In early days, I used different methods, different strategies. And then today, I'm mainly using on Elliott Wave as a technical analysis. And this is common. And I need you to also understand that as traders, our strategies evolve, our style evolve as well, because our lifestyle change, right? In the past, I might have more time to look at the chart, and then right now I may not want to do that. Okay, and with that shift, your strategy, the method that you're using to approach the market needs to shift as well. Okay, one of the biggest lessons I've learned, of course, is risk management in trading, and I learned it through losing a $20,000 account. So hopefully, again, whatever strategy that we're talking about, whatever strategy you're using, risk management is still one of the most important aspects of trading and investing. Okay, so make sure you focus on that as you're actually discovering different strategies and you're applying them as well. So I managed to turn full-time trading and investing by 2015, and since then I've been enjoying this process. Okay, trading, investing, and at the same time also sharing what I've learned, what I know, my experiences with fellow traders like you guys today. Okay. So very quick one over here for those of you who are also quite active on social media, whether it's on Facebook or Instagram. You can actually follow me, but I just want to very quickly highlight over here as well that there are many fake accounts recently on social media. Okay, whether it's Instagram, some even on Telegram. They are actually scam accounts trying to cheat money, right? So be aware if you're active on social media, these are the only two accounts that I have in terms of the URL. Okay, so there are a lot of all these other fake accounts that uses maybe my name or even my profile pic, okay, to reach out to traders and investors. And usually they go along the line of asking how your trading is, how your investing is, and then they'll start to introduce you to certain new things, okay, and then they'll ask you to transfer money to them and things like that. So anything similar to that, okay, just be very aware that it's not me, okay, because I would never reach out to you personally to actually share with you stuff like that and ask you to transfer money over, okay? So if you receive any messages sort of, asking you to transfer money, just be very, very sure that it's not me. If you need to, always clarify, okay? And you need to be very, very careful because nowadays creating a fake account is so easy, okay? So I just want to put this up so that you are aware, you're able to protect yourself, and you'll not fall, to such scams. Okay. Now over here, I also want to very quickly share with you last year. Okay. Of course, moving forward, I also update, from January to March this year, how's the performances. I haven't done that, but this is actually last year's result. Okay. And I want to show you this to highlight the fact that whatever we are sharing over here is not based on theory. Okay, I think that's important for you to also gain that confidence to know that whatever that we're covering today, they're very practical information that you can use it for your own trading. Okay, now I'm not saying that after today's session, you're going to be like a professional in Elliott Wave or, you're going to be a pro in technical analysis. But I just want to show you that everything that we cover, okay, if you pay attention today, you'll be able to take it and apply it into your own trading, and you can definitely see some results, ideally to help you improve on that as well. Okay, so today's webinar, what we're going to cover over here is number one, to share with you, to give you an understanding of what is an impulse, what is a correction. Okay, so as I mentioned, this is like the essence of Elliott Wave. This is like the most important foundation of it. Okay, and if today you want to take your technical analysis from Elliott Wave to the next level, This is something that you need to be very, very strong with. You need to be very confident in, okay? We'll talk about the building blocks of it as well. And last but not least today, by the end of the session, okay, if you understand impulse correction, if you're able to apply what we talk about today, you'll be able to achieve this thing called determining your directional bias. Okay, directional bias here, I'm referring to when you look at the chart, when you look at an instrument, right? Any particular time frame, you'll be able to very quickly and confidently decide a direction that you want to focus, right? So for example, you know, if you ask about, oh, what's the directional bias of gold, XAU USD, right? Applying this principle that we're going to cover with you today, you'll be able to like quickly establish and say, oh, gold, I'm looking to buy, gold, I'm looking to sell, or gold, I'm looking to remain neutral, right? So that's what directional bias means. You have a clear sense of direction that you want to be focusing on. Okay, and that's the end goal that we want to achieve today, right? Any chart, any instrument, any particular time frame, when you apply this principle, you'll be able to determine whether you focus on buy, sell, or not to trade at this moment. Okay, so let's get started by first understanding what is impulse and correction, okay? Because this is like the most important element of all. Okay, so impulses here, we're referring to any movement in a chart that have a strong momentum that moves off very fast. Okay, good. So I'm seeing some of you say no sound. I think should be good, right? So just now you guys are able to hear it. So maybe it's your side, right? So do check your speaker. Okay. Good. So impulses, as I mentioned, they're basically fast momentum move, okay? Which means that any particular instrument, if you see a very strong candle, you see the market prices move off in a particular direction very strongly, those we categorize them as impulse, right? So it can be either direction. It can go up fast, it can come down fast. We call them impulses. Okay, so in any charts, there are only two exist, right? One is the price movement of it, one is the time scale. Okay, so when we're talking about impulses here, we're referring to the price move in a very huge momentum, right? So in terms of price changes, it's huge. And then in terms of time duration, it's short. Okay, so that's what we meant by strong momentum, right? Very huge movement, relatively short period of time. Those are impulses. Now, if I bring you over to a chart, okay, so this example over here is a chart of Netflix, okay, and this is a time frame on the daily scale. But as I mentioned, you can apply it on any time frame, okay? But I just want to highlight different instrument, different time frame, right? So this is a stock chart. This is on a daily scale, and we can see at this point here we have an impulse move down. Okay, very, very fast, relatively short period of time. And if you are familiar with this thing called candlestick, you start to realize that the candle colors are majority red, okay? And the body of the candle is huge, right? So this is what we call impulses, okay? Same thing over here, you can see as it's coming down, majority of them are in red, and the candle of the body is huge, right? So those are what we call impulses. Okay. Now another example over here, this is a chart on GBP USD, which is a currency chart, okay? And it's also on the daily time frame. You can see this move down is fast, this move up is also fast, right? So the characteristics of an impulse is you realize that the candle colors are majority in one color. Okay? That means that it's very clear that the market is going in a certain direction, right? So it's fast and it's clear in direction, okay? More example over here, you can see this drop here is very clear impulse, okay? Red, huge candle. This up move here also, right? Consecutively, few white candles, red, huge candle down as well. Of course, we also have this as an impulse down, as an impulse up, right? So that's the idea of it. Anything that is fast, strong momentum, those are what we call impulses. Okay. Now, the market can only move in two types, right? One is what we call impulse, fast. If it's not going fast, then naturally it's going slow, right? And that's where we categorize that as correction. That's the second category. Okay. So corrections is kind of like the opposite. It takes a longer time. It's slow. It's not really going anywhere. Okay. Some descriptive words you might use is like it's range bound, you know, it's not going anyways, range environment. The market is ding dong, right? Up and down, up and down, up and down, but there's no very clear sense of direction, right? These are what we call corrections. Okay? So corrections here can be slanting to the upside. So it can be going up in a very, very, very slow environment. It can be slanting down, right? And it also can go sideways, right? So there are generally three directions a correction can develop: slanting up, slanting down, or sideways. Okay, so just give you a very quick example of it, and you can see visually some characteristics of a correction. This one here, you can see, firstly, very obvious. Okay, I'm using white and red candles. Okay, you see a lot of like mixture of white, red, white, red, white, red. Okay, so those are what we call corrections, because the market went up a little bit, it comes down a little bit, it went up a little bit, it went down a little bit, right? So that's where you get a lot of white and red overlaps. Okay, and of course, you can also see it from a perspective where it's really not going anywhere. It's slanting to the upside, but it's not fast, right? So those are correction. This one here as well. Okay, you can see sideways chop, red, white, red, white, red, white, right? Here as well. Okay, so again, this example here can clearly illustrate like correction and impulses, right? Correction is slow, impulses are fast. Same thing here, you can see, right? Fast move, slow move, fast move, slow move. Okay, this is a chart on Apple, right? So stocks, commodities, currencies, the principle applies. Okay, this one here is on silver, so it's a commodity chart. So you can see fast drop, right? Huge red candle, mixture of white and red, so it's a correction. Huge red candle, huge red candles, and then mixture of white and red. Okay. So it's actually something that you need to develop the ability on identifying them. Okay, of course, if you're very new to this principle, it might take a little bit of time for you to familiarize with it, like what is impulse, what's correction. But the principle is fairly straightforward. Okay, you don't want to overcomplicate it. Now, at a certain point in time, sometimes you might say, oh, what about things like that? Okay, is this a fast move or is this a corrective move? It seems to be like both. Okay, you have like big red candles down, big white candles up. But at the same time, you get some smaller ones. You know, there's a lot of red and white mixed together. So things like that is where we say it's confusing, it's not clear. And what you do as a trader is whenever you encounter something like that, then just let it go, okay? Don't try to force something in. And all you have to just simply accept that right now, this particular instrument and this particular environment is not clear, okay? And then you move on to the next chart, you move on to the next instrument that you're interested in. So be aware that not all the time is gonna be like what we call picture perfect, where it's clearly an impulse or clearly correction. Now you're gonna get examples like this, which is very clear, and you're gonna get an example like this, that's not clear, okay? So your role as a trader is to focus on those that are clear and avoid those that are not so clear. Okay, follow me, right? This is something that I thought is important to bring up because a lot of times I see newer traders who are trying to practice this principle kind of get stuck when things are not clear and then they try to force something in. Okay, don't do that. Focus on those that is super obvious, right? Even we like to say even a 3-year-old, 5-year-old child can look at the chart and tell you, oh, this is impulse, this is correction. Those are the things that are clear. Okay, so this one here, I think is a good example of things that are not clear, right? So when we look at certain charts, right? So I see some questions over here as well. I see here Chen asking, can we take a look at dollar yen on an hourly? And then Easy Trade here says when there's neither an impulse or correction, how do we use it, right? So maybe when we're here talking about impulse and correction, I'll very quickly just bring up some current chart examples, okay, to really illustrate this first, okay. So since you brought up dollar yen, right? So we'll just look at dollar yen. Let me open up a new chart. Okay, and we're gonna focus now just primarily on what we call impulse and correction. Okay, so look at this here. Okay, for me, I always start off with the most right-hand side of the chart, right? And this is where the market price is, and we'll just look at this environment and ask ourselves, does it look more of a correction or an impulse? Okay, so the part here is you always ask this guiding question. Is the market developing fast or is the market developing slow? Now, fast and slow is a relative thing, right? So you obviously need to have some kind of comparison. Now, if you look at this move here and you look at this move here, okay, and we are able to then compare, right? Because it becomes very obvious, okay? Now, so very quick one, okay? Maybe you can do a little bit of practice just by typing in on the chat, okay? This move here, if you think it's fast, you type an I, right? I stands for impulse. If you think that this is a correction, you type a C, okay? So if you think this is an impulse, you type an I. If you think this piece here is a correction, you type a C. Okay, so very, very quick practice on that. Okay, yeah? So good. I see over here, long say C, Oi say C. Okay, good. Okay, so practice, right? Just type it in so that you can gain that confidence after today's webinar as well, right? So you know how to identify impulse and correction. Okay, Mahamud says C, ESH says C, Jiajin says I, okay, impulse, right? So we get most of you right now, I'm saying here is C, and then Jiajin says impulse, right? So very quick, if you take a look at this environment here, first off, the market is definitely coming down. There's a sense of direction, but you start to observe, overall, we have like red, white, red, white, red, white, red, white. Okay, so this is the characteristic of what we call an overlap. Okay, a lot of white and reds. This to me is a slow move. Okay, so we put it under the category of it's developing slowly. Now this here is obviously very fast, right? One huge red candle. There's not much of an overlap. Okay, so that's an impulse. Okay, more example as we progress. You know, you can see this here. This is also to me an impulse, right? Why? Because we have majority big red candles. We only have like one red one in between. So that's a fast move to the downside. This piece here, I think this is obvious. This is slow, right? Because it's up, down, up, down, up, down, up, down. That's a lot of what we call an overlap. So that's a correction. Okay, it's a very slow moving piece. Okay, this piece here is fast, right? You can see overall there's majority in the white candles. So those are impulses. Okay, so in terms of like dollar yen, you can see right now this is clear, right? We have a fast move, we have a slow move. Okay, so we have an impulse and growth. So things are clear here. Okay, certain things may not be clear, right? So if you take a look at this example, maybe I'll play around with different time frames to illustrate that idea. Okay, so if you take a look at this and you start to ask yourself, right, is this fast or slow, this piece, right? If things are not clear, okay, move on. Okay, don't get too fixated in deciphering what is happening. Okay, because there are certain charts that are super obvious. Okay, focus on those. Okay, yeah. So that's a very quick illustration of impulse and correction on dollar yen. Okay, so over here, just now we did mention a little bit in terms of like the characteristics of a correction, right? It tends to be slow. It tends to be wavy, choppy, up and down, right? And the idea over here is when you start to see a lot of fast move within that time frame that you're looking at, okay, you want to consider shifting that into a higher time frame. Okay, so give you an example on the chart, right? When you see something that looks like this, right? Like what's exactly happening here? There's like a lot of ups, a lot of downs, and they're relatively fast. So when you see a lot of all this move within your time frame, a little technique that you can actually use is to zoom out, right? So this is actually a chart on euro dollar on a 1 hour scale. Okay, and we see a lot of like impulses up, impulses down, impulses up, impulses down, impulse up, impulse down, right? So when you observe something like that on whatever scale that you're looking at, it seems a little bit confusing. What you do is you zoom out, right? So from a 1 hour chart, you go over to a 4 hour scale, and you start to realize that, oh, whatever we're seeing on a 1 hour chart is essentially what? A correction, okay? Because they're basically just ding-donging inside it. Okay, so this is a little technique that you can actually remember as well. Whenever things are maybe not very clear, okay, you may want to consider going on a higher time frame to gain some clarity out of it. Okay, but don't overdo it, right? Don't say, oh, from 1 hour, it's not clear, I go to 4 hour, 4 hours, it's not clear, I go to daily, and then go weekly, and then monthly, and then it defeats the purpose of you trading. The idea is play around with maybe at most 2 time frames. Like if you're doing it on a 1 hour, you can look at 4 hour. If you're doing it on 4 hour, you can go daily. If you're playing around with different time frames and things are still not clear, means it's not clear. Okay, then you focus on something that is better for you. Okay. So once you are able to kind of identify the impulses and the corrections in the market, right? What are fast, what are slow? The next stage is where we put things together. Okay. So think of it as, I always say, Lego piece, right? If today you have like a variation of pieces that you can use to build something, then the scenarios of how certain things can play out is kind of finite, right? Because if you only have, let's say, 4 P's, okay, up impulse, down impulse, up correction, down correction. If you only have this 4 P's, then your permutation of it, your mix and match of it, right? The variations of what you can get out of this 4 P's are kind of like limited, right? There are different sets of it, but you have a finite number of it happening, okay? And that's where we come to the next stage here on understanding the 3 core combinations, right? Because if we have this 4 P's, we play with the mix and match, we can't get this 3 primary combinations, okay? And what are these 3, right? So let's take a look at them. Over here, we have the first category, okay? So they're basically the same, it's just a mirror effect, right? So this one here is a mirror, meaning opposite direction. But the combination is the same, right? So you have an up fast move, which is an up impulse, a down correction, okay? So what we are doing here is we are taking an up move, then we put the next possible set here, right? Which is a slow move down. Then the next piece here is a fast move, and then we combine it with a fast move down. Then the third set here is basically a fast move up, and then a slow move up, right? So basically the first piece of it is the same. It's all fast move up. Then we just take a slow move down, a fast move down, a slow move up, and then you piece them together. Now, if the market can only move up or down, and the market can either only move fast or slow, then this would be basically, I would say 99% of the time, what you would see on the chart, okay? Because you are taking a fast move combined with slow move, fast move combined with a fast move down, fast move combined with a slow move up. There's basically no 4th possibility, okay, in a way, right? And then we flip this to the downside, right? So fast move down, slow move up, fast move down, fast move up, fast move down, slow move down. So once we're able to identify these 3 combinations, I would say 90% of the time, this is what's happening in the market, right? And we can't call this patterns because they tend to repeat itself. They tend to occur frequently on the chart, and they carries a certain form of probability, okay? And we're gonna go into each of this combination, each of this pattern in a little bit more details, okay? So let's start off with the first one, okay? So the first one here, we call it impulse then correction. Basically, we get a very fast move, following that a slow correction, okay, in the opposite direction of the impulse. So whenever we see this combination, that's where we have a high probability opportunity that we can look into, okay? So this one here is where we talk about this thing called the directional bias, right? Directional bias here means which direction we want to focus on, okay? If we have a bullish directional bias, we focus on the buy side. If we have a bearish directional bias, we focus on the sell side. If we don't have a clear sense of direction, then we'll be just neutral, right? We'll be patient on that, okay? So whenever we see the first combination of an impulse then correction, we have a clear sense of direction that we can focus on, okay? And because of that, we have a potential trade opportunity, right? Because we have a clear sense of direction where it's going to go, we can look for a trade, okay? So give you some example of what this combination kind of looks like in a chart, okay? So this one here, you can see fast move, correction, right? So this correction is actually coming slightly to the downside. Okay, it's in the opposite direction of the impulse, right? But it's slow. So whenever we see this, you realize that what happened next in the market, it went up fast. and then it does a sideways move again, a correction, and then what happened next is it goes up fast again. Now this is obviously completed. This pattern is done. Okay, the combination has finished. But what we can study from this is what we call pattern recognition, right? You realize that, oh, every time we have an impulse and a correction, we have an impulse and a correction, it tends to tell us the next move, okay, with slightly higher probability. I mean, it's not going to be 100%, but we realize that in this example, we can't get a quite high accuracy. Now, based on my experience here, we can get as high as 70% probability of it moving in that direction. Okay, now if I flip it in the opposite, right, we get a fast move down, a sideways correction. The next thing that we observe, the market went down fast. It does a fast move down, it does a correction. The next thing the market does, it goes down fast. It does a correction, and the next thing it happens, it goes down fast. So again, we start to observe, right? That's something that tends to repeat itself over and over again. Whenever we have an impulse correction, we have a clear sense of direction. Okay. So what does this mean to you as a trader, right? Obviously, this is done. You won't be able to trade it anymore. But what this pattern, what this combination actually tells us is that in the future, if you see this, then you jolly well be focused on a particular direction, right? Because it has a high probability of that happening. So this one here is where you get an impulse up, you get a sideways correction. And we know, right, when this tends to happen, the market has a higher probability of it going higher. Now, it may not be 100% going up, but we know if we have a good 70% chance it's going to go up, then we want to focus on that, right? That becomes what we call a directional bias. Okay. Same thing here. When we observe something like that, a fast move drop, and then after that, a correction starts to develop, we have a clear sense of direction, right? We'll rather focus on the sell instead of like looking to buy, right? Because 70% of chance is going to drop. So that's where we want to focus on. Okay. So that's what the first combination does. It gives you a sense of direction based on very simple principle of impulse plus correction. Okay. So we always focus on the right-hand side of the chart. You realize that. Okay. We always look at what is currently developing. Okay. Now that's the first category. That's the first combination. Now the second combination is where we have like two impulses, one after another. Okay. So in this sense, we usually avoid trading. Okay. Our directional bias would be neutral. We wouldn't want to take any trade. Okay. So this kind of things, we usually call it a V shape, right? Because essentially they look like a V. Okay, when you have two impulses put together, it looks like a V. So example of it, okay, when you have something like this, a fast drop, a fast move up, fast drop, these are all impulses one after another. We avoid trading. Okay, because why? We don't have a clear sense of direction. The chances of what's going to happen next is almost like 50-50, right? There's no high probability direction. We avoid trading it. Okay. Same thing here. You can see, based on historical pattern, every time we get a V, it's random. You get a V here, it comes down. We get a V here, but it goes up. We get a V here, it comes down. We get a V here, but then it chops a bit, right? So basically, there is no clear pattern. Okay. When there's no clear pattern, it's not reliable. We just don't want to trade it. Okay. So what this means to you in the future is whenever you just look at a chart and you observe, oh, the market only has a V shape, or the market just ends off with a very fast move, you don't want to be executing any trade, right? In a way, we say that our directional bias right now is neutral. We wait. Okay. So under the course, what's going to happen next? There isn't much of a high probability move. Okay, so we don't move, right? We just observe. Okay, same thing here. If the market just comes down very fast and it ends off as an impulse, we wait. Okay, we don't want to establish any form of direction. We just avoid this trade entirely. Okay, so this is quite straightforward, quite clear. When you see an impulse, when you see a V, and that's it, you wait. Okay, you don't jump into the trade. So that's the second category. And then the third combination over here is what we call impulse then crawl. Okay. So what this means is that you get a very fast move up, following that, the market continue to move in the same direction, but it's slowing down. So often this can indicate a potential reversal is coming because it can suggest that the momentum is dying off. There's not so much of an opportunity in the same direction anymore, right? Then our focus here is, if you're a kind of counter trend trader, you'll be looking at the opposite direction, right? You'll be looking at a reversal trade, okay? So this is the part where I show you some example. You can see this fast move up. It continued to go up, but it's slowing down, right? So this is definitely slow. A lot of red and white overlap, and it's not going fast anymore. So when you see this combination, you observe what happened. The market reversed, okay? The market at least put in a fast move down first, right? Then whatever happened next is actually a combination of impulse correction, impulse down. This is a V, no trade, right? But basically you can't capitalize on this move here, okay? Another example, a fast move down, it starts to slow. And then what happened next? It reversed, right? So in a way, we are actually looking at this as a pattern that there is some form of a reliability factor, right? There's a high chance it will happen, right? Same thing over here. Upside fast, starts to slow, reverse, okay? So what this means again to us as a trader is, in the future, if we see something like that, okay, it is telling us two things. One, don't buy it anymore, okay? Because this here to continue going up in a fast manner, the chances of it happening is not that great, okay? Nothing is in certainty, but it's not high in probability, right? And whenever we see this, the second thing that is telling us is that this coming down has a higher chance, okay? So what it means to you as a trader is, we wouldn't want to be buying when we see this. We would rather be looking at maybe a potential sell, okay? Same thing here. If you see a fast move drop and then following that a crawl, okay, we wouldn't want to be selling this anymore, but instead we'll rather see if we can look for a buy trade opportunity, okay? Can follow that thought process, right? So this is essentially the three kind of core combinations that we have based on like the basic, simplest form of Elliott Wave understanding, okay? And I call this the foundation because this literally builds up everything that you would probably need when you want to advance yourself in terms of Elliott Wave trading, okay? So allow me to quickly also go through some examples of the chart, right? I see some questions coming in as well. But let me just very quickly go through some examples of clearer ones, okay? Clearer ones. Like, for example, okay, if you take a look at dollar Canadian right now, okay, of course, have in mind, so I need to put this out as a disclaimer as well, right? It takes more than just the impulse and correction to establish what we call a trading plan or strategy. But again, today's objective is to help you establish the direction to focus on, okay? You definitely need to still add in elements like when to get in, you know, how are you going to execute a trade, how are you going to manage the trade. All this still needs to go in as part of the trading plan, okay? But for today's purposes, and of course the time limitation, we're going to be focusing on giving you the ability to determine the direction to focus first, okay? So if you take a look at example of like dollar Canadian, okay, what we have right now over here, this is on the 4-hour scale. You get this piece, which is basically a correction because there's a lot of overlaps, white red candles. And then if you compare the move before this, we have this little drop, okay? So relative comparison, this is fast, this is slow, okay? So we can't get an impulse correction combination, right? So this pattern suggests high chance downside, right? So when we look at something like this on the chart, very, very quickly, we can say that, oh, our directional bias here is bearish, which means we're not so keen on buying this up, but we'll instead look for sell opportunity, okay? And of course, as I mentioned, you need to add in layers in your trading plan, you know, where are you going to sell, how are you going to manage your trade, how are you going to manage your risk, etc. But based on just this, we know we want to focus on the sell instead of buying it up, okay? So you can see very quick, right? Once you're familiar with the patterns, the combinations, when you open a chart, within that few seconds, you can really establish what we call a direction bias, okay? Some charts may not be the clearest, like for example, dollar franc, right? Just now we did bring this up as well, right? Is this correction? Is this impulse? Is this V? When things are not clear, what do? You skip, okay? You don't touch it, okay? Like dollar yen, 4-hour chart, okay? Maybe it may not be the clearest here, but on the 1 hour, if you can see this as a slow move, as a fast move, what is this combination, right? It's basically an impulse plus a crawl. And we talked about this just now, right? When we see this, we don't want to be too aggressive in selling anymore, but instead we may be looking for a potential reversal. Okay, so you can't have a sense of direction, right? So if you're not a counter trend trader, you do what? You remain neutral. If you're a counter trend trader, then your bias is what? Focus on the buy side, right? Because you'll be looking at a potential reversal soon. Now, with this ability, I'm going to move a little bit ahead, okay? Now, if you understand that the market can either move fast or slow, that's generally only that 2 types, right? So what's happening next year is you can project. If this goes up fast, okay, that's great, right? So what we get is a fast move down, a slow move down. This is a crawl. We anticipated the reversal. If this is going to be a fast move up and following that, the market does a correction here. Again, we are familiar with this pattern, right? Impulse, correction. We project this to continue going higher. So you realize what I'm doing over here is what we call forecasting. Okay, the market hasn't happened yet, but we can kind of visualize it. Okay, why we're able to do that? Because we understand the different pieces of how the market can develop, fast or slow, and then it can either go up or down. Okay, any chart, most of the parts of it, you can actually categorize it fast or slow, right? In this case, this is slow, this is fast, this is slow, this is fast, this is slow, this is fast, this is slow. Okay, this one here is slow as well. This is fast and this is fast, right? So this is fast too, right? So you can realize that if I break down a chart into pieces, okay, it's either going to be fast or slow. And if you're familiar with the concept of, you know, like permutation or Lego pieces, it's basically just mix and match, right? You take one piece, you put it here, hey, does it look good? You take it away, you put another piece in, and then you look at it, oh, what pattern is it? Basically, that's what we're doing, okay? But of course, it's easier said than done. It requires some form of practice. It requires you to be very familiar with impulse and correction. Cool? Okay, yeah. So let me very quickly, look at some of the charts that some of the questions that you may have popped in, which may help in your understanding of impulse and correction as well, right? So I see over here a question from Rocket Czar asking, normally how long does a correction phase last? How do we know when to enter in anticipation of the next momentum, right? This is where we take it to the next level, right? So today, once you establish the direction, the next thing you need to establish is the timing, okay? Like, as you mentioned, right? When would this correction likely ends? That's a little bit in the second part where in Elliott Wave, we have certain principles, certain guidance to help us. But to keep things simple for you today, most of the time, the impulses are fast, which means if the impulse takes 1 day, then the correction, you want to give it a multiple of at least 2 to 3 times, right? So if it's a daily scale, this is 1 day, then this one here at least 2 to 3 days, okay? Minimum. Give and take, right? So if you're looking at a 4-hour chart, if you have a 4-hour candle down very fast, then this one here at least give it another times 2 to 3, right? So that's about 8 to 12 hours, which is almost as good as another day, okay? So that's a quick guidance, right? To kind of give you an element of time, an element of skill, okay? But of course, when you proceed into a better understanding of Elliott Wave, we add in elements of like counting the swings, counting the fits, right? That can add in to complement all this timing factor, okay? But bear in mind, it's never going to be picture perfect, okay? It's never going to be like textbook answer in trading, okay? But the idea is everything that we are talking about here is kind of a framework, right? It's a guiding principles to help us trade, okay, to give us a higher probability, but it's never going to be 100%. Okay, so bear that in mind. Another question over here I see is, can I know this chart pattern work best on a day chart, hourly chart, or minute chart? Again, to be honest, it can work on any time frame. Okay, because we're talking about technical analysis, and the beauty about it is the same thing you can actually observe in various scale. Okay, but of course, sometimes certain time frame may be clearer. For example, like dollar yen, we can see something very clear here on a 1 hour. If you go down to maybe on a 5 minute, you may not see exactly the same thing, right? Maybe 5 minute here, you'll be seeing this as a fast move. This is a slow move correction that is potentially developing. Okay, and then we'll look for more upside on the smaller chart. Okay, but you can still see elements of it in terms of like impulse correction. This is a little bit of a slow move. This is the fast move, right? This is the fast move, but this one here is difficult. It's choppy, right? So then you avoid it. Okay. If you go to daily time frame, can you spot it? Yes, right. So this here, you can say that this is fast. This one here is a little bit mixed, right? It's coming down, but there's quite a bit of overlap. Right now, we're probably developing a correction. It's chopping sideways, not going anywhere. It's taking a long time to develop. But based on daily, you get this as a drop. You get this as a sideways. In the long run, we'll be anticipating what? One more drop, right? So impulse correction, impulse down. So you can apply this principle on any scale. Okay, of course, you then also need to make some adjustment according to the particular time frame that you're looking at. Right? Now, based on my experience, if you're fairly new to this principle, don't go and try apply this on like 1 minute, 5 minute, 15 minute. Okay, because things move very fast on the lower time frame chart. If you're still new to a certain principle, give yourself that time to practice, right? So work on it on a 1 hour or even on a 4 hour chart. Okay, I use this primarily on a 4 hour chart because I'm more of a swing trade. Okay, so 4 hour is actually like the best time frame for me. Okay, so Chen here also asked, right? Is it suitable for scalping? The answer is yes, right? In a way, if let's say tomorrow we have NFP, right? And if you are looking at like news trading and sort of, okay. Of course, today is still too early to talk about scalping NFP or trading NFP tomorrow because things can really move a lot in the smaller time frame. Things can shift quite quickly on a smaller time frame. But let's just say, okay, from today onwards until tomorrow, okay, or let's just say hypothetically, NFP is later. Okay, so what can happen over here is if this continues to develop like that, okay, what do we have? We have this as a fast drop. We have this as a crawl. Then we'll be having a clear sense of directional bias, right? Because we'll then be looking for this potential move. So we can then use this also as part of the news trading aspect to scalp it to the upside, right? I mean, this is on a 15-minute chart. So the idea here is if this is going to be a crawl, we look for the buy, we can actually use what we call a breakout technique. Okay, when the news release, the market does indeed move higher, we'll get involved in a breakout, and then we'll catch this move here, right? So you can use this technique here to complement like the different style of trading. Okay, because what we're covering here is not, it's not like a fixed strategy itself. It's a principle that we use to analyze the chart. Okay, so this principle, you can use it to customize it for short-term news trading, for scalping. Okay, you can customize it to fit your maybe day trading, swing trading, or even as a long-term investor. Okay, so what I mean by that, for example, if you are looking at NASDAQ, okay, for example, yeah, and you're looking at investing, so you're looking at maybe on the daily scale, right? When is the best time to put in your position to do for long-term investing, okay? So maybe right now what you see on the daily scale is we get this move. You do not want to just jump in and position your add in your investment position at the top, right? But what you can then do is you can wait for this to develop a correction. It gives you the probability that, oh, yes, this indeed will likely continue higher. Then you can also use this to position your longer term move, okay? So same principle, depending on the style and the strategy that you eventually would use as you're trading. you need to, of course, cater to that, right? You need to tweak a little bit to fit whatever style that you're using. Okay, good. So another question I see here is from Easy asking, you know, pound dollar hourly chart, it looks like an impulse then crawl. Okay, this is not an impulse then crawl. Okay, this is more of an impulse then a correction. Okay, a correction is the opposite of the direction of the impulse, right? So you can see this goes up fast, it comes down slow, right? So that's what we call impulse correction. A crawl would be an impulse and then it goes up like that. Okay, so it looks different, right? It looks different. So again, this takes a little bit of practice, right? So this is a correction, this is a crawl. Okay, so that's the distinction between the two. Another question from Liu asking, can we perform a back test? How do we ensure we did not identify it wrongly? Yes, you can definitely back test this, right? So usually how to do it is you just take any random chart, okay? And then you randomly scroll all the way to the back, okay? Random, and then you say, okay, let's stop there. You can use this function here called a replay, and then you just replay this, okay? And then you start playing forward, right? So just imagine right now, this is where the chart is, okay? And what we observe is we have this crawl and then we have this fast drop. Okay, so the market ends off just as an impulse, right? So we do nothing. Okay, then you can play forward a little bit. Okay, so play forward a little bit, play forward a little bit, and then you start to see, oh, okay, if this is going to develop eventually into a correction, then we have this combination of an impulse correction. Then our directional bias becomes clear, right? We'll be likely looking for a sell. Okay, given if this continues to develop slow. If this just goes back up fast, then we have a V, then no trade, right? Our bias will be neutral. Okay, so then of course we can play forward a little bit. Okay, this one looks a little bit more of a correction. So you can actually do a little bit of like practice, right? Then we'll say, okay, we'll expect this move down. Okay, of course there are more elements to it, but today for simplistic purposes, we just do that, right, as an exercise. Okay, so this is what happened. Great, right? It played out. Okay. And then next, after this, what we have is this probably would just, you would probably start to look at it. Oh, this is an impulse. So what we do, we wait. Okay, we wait for more information. Okay, now it looks like a V. We wait for more information. You know, nothing much. Oh, okay, maybe you would start to practice and say, oh, this looks like impulse and a bit of a crawl. So maybe we'll expect a little bit more reversal to the downside, or at least don't buy. Okay, so what we do, we push forward a little bit. Oh, okay, it doesn't really move much. It just comes down. Okay, now things change a little bit, right? From here, it's more of a correction now, right? It doesn't really come down all the way, but it's a little bit more of an impulse correction. So what we can then do, we practice next, right? We say, okay, maybe this would be going up. Okay, then you practice, right? So this didn't work out. Okay, so this trade here, or I say this trade, if you took it, it will be a stop loss trade, right? So it didn't work out, you move on, right? So what's next? It's an impulse. Wait, right? So what happened next? Give it time, is a V, nothing much. Next, okay, and that's how you practice, right? I think you get the idea of it. Okay, so when you're doing this, what we call back test, okay, you probably need to also track, right? Like this one here, if you bought it at what point, maybe it didn't work out. If you're using a breakout, then you wouldn't have executed a trade. So you need to add in those elements, and then you track, you journal down, right? How many of these patterns play out? How many of those patterns doesn't play out? And then you have a number of statistics, right? Data point for you to work on. If you look at those data, you will probably come to the part where this pattern has a good about 70% probability of playing out. Okay, so that's the idea of it. Okay, you can actually do this practice to build up your confidence. Cool, huh? So I hope that clarifies the aspect. Cool, so those are the things that I have prepared for today. Okay, kind of also managed to answer a bit of the different questions that you guys have actually typed into the chat. I think we do have a little bit more time, okay, but maybe I'll pass the time back to the moderator first and see if later on you guys have any other questions, then I can follow up from there on.
Yeah, thank you, Kayong, for sharing and also answering most of the questions. I think there isn't much questions left, but maybe one or two. would you be happy to take on later on? Kayong?
Yes, can.
Okay, so let me start with some of the sharing first. Reminder, if you want to chat with us, remember to log in to your MQ Trader account or sign up for an MQ Trader account. And also I remember there's one question asking about the Telegram QR code. I think you are mentioning is the MQ chat QR code. So here's the MQ chat QR code where you can PM them to add you to the group where they send daily market updates. So remember to screenshot this or save this QR code for your later reference. And if you're interested to open a trading account with Visit Plus, please do so now because they are having a welcome credit campaign where they are giving out USD 100 to all who deposit at least 500 USD and above to their new VC Plus trading account. The trading account opening is free and it's totally online with VC Plus. So remember to sign up for one if you're interested. And for MQ Trader members, remember that you can claim your check-in rewards of 300 MQ points. You just need to submit your screenshot in the post-webinar quiz. And if you haven't registered for this webinar, please do so now so that you can get all our post-webinar updates, including the quiz and also the recordings. We will be starting our mysterious gift session very soon, so do stay tuned for it. And Kayu, I think I've compiled and also there are some questions left. I think there's one question asking, can you take a look on the USD JPY hourly chart? It's quite specific.
Yeah, I think just now I went through that as an example as well.
Oh, okay. Maybe they overlooked it.
Yeah.
It's on the hourly chart, is it?
So yeah. So we were talking about the example of like impulse and correction, and then we use this chart.
Okay. Yeah. So this is the chart that that can be used for Chen WC. Okay. Yeah, I think that's all for the questions for today. It's a short one. And thank you once again, Kayong, for your sharing and also answering all the questions laid out by our audience. Let me just share my screen back. Hold on. Can you guys see my screen? Because I think my screen freezes a bit. Okay, I think you can see my screen now. Okay, so let's start our Q&A session since we have ended our Q&A session. Sorry, let's start our mysterious gift session since we end our Q&A session very fast today. So remember, we will be giving out gifts worth up to 249 ringgit. We will be displaying the question and also answer option on the screen. We will be choosing the first 2 persons who answered correctly for each question to win the gifts. So get ready your keyboards, get ready your MQ Trader account so that you can chat with us and use the chat box to send in your answer. Get ready? Everyone ready? So we will start now. The first question, what are the 2 main market movements shared by Kayong today? He has been questioning you from the very beginning, the I and C, remember? So what are the 2 main market movements shared by Kayong today? It's quite obvious. The I and C, remember? Okay, I saw a few answers coming up. Let our team compile the winners and announce it soon. So the answer is C, impulse and correction. Impulse is fast and correction is slow, and correction is in the other way of the impulse. So I believe we have a winner here. Just a note to everyone, the winners may be different from what you see on your own display because depending on the internet speed of your own screen or of your own device. So we will, based on our main device, to choose the winners. So the winners for this first question is Dotless73 and Yoklong. So remember to use the link on the screen or link in the chat box to send in your contact details so that we can arrange the gifts. Okay, so for others, let's get ready for the second question. Ready? Number 2, what does Kayong suggest when we see impulse then impulse combination? Impulse means the fast reaction. I think it's the V shape. Impulse then impulse. What do we do? Or what does Kayong suggest us to do? Okay, so I believe Kayong also mentioned a few times in his example. Impulse and impulse. When we see this, we will need to be patient and wait for a clear direction of the movement. So I see a lot of you getting it correct. So it's A. Let our team compile the winners as well. Okay, the winners is Ui Bi Hui and Wei Xian Chu. So remember to use the link to send us your contact details, your email address, your address for us to send the gifts to you. We have our last question on the screen now. So get ready. Maybe you can be our next winner. The third question. Under MQ Referral Campaign 2023, what do you need to do to gain the bonus of 1,000 MQ coins? 1,000 MQ coins is equivalent to 10 ringgit. So what do you need to do? Is it do nothing or just join our webinars? Any answers? Oh, you guys did take note on our marketing or introduction slides as well. Very good. So the answer is B, D, be MQ affiliate and refer people. You just need to be our MQ affiliate and start referring people within the campaign period, which is from 14th of March to 30th of June. So you refer people, once they successfully open trading account with our selected advertiser, you will get the 1,000 MQ coins. Great, so that's all for today. And our winners for the third question is Robert123 and Ahmad Zamil. So remember to use the link to send us your contact details by today before the webinar ends so that we can arrange the gifts for you. Welcome, Oi Bi Hui. Okay, so remember VC Plus is having this welcome credit campaign. So if you are interested, do scan the QR code here and submit your contact details or open a trading account with them through this QR code. And here you are, the MQ referral campaign, where you can get 1,000 MQ coins for each successful referrals. So if you are not yet an MQ affiliate, you can scan the QR code on the screen to join as MQ affiliate now and start referring once your account is verified. And a heads up here, MQ Trader will be co-organizing the i3 Investor Summit 2023 with Investment Summit with i3 Investor. So it will be on the 20th of May, a Saturday. The theme for this event is to prepare us to invest in a recessionary environment. It's a whole day event where you can get to see face-to-face a lot of investment brokers or analysts from different sectors. You can also get information from almost all types of investment instruments available on the market on the event day itself. So ticket information will be out very soon, and there will be early bird discount as well. So remember to sign up early. And I can guarantee you the ticket price is very reasonable and very affordable. So do stay tuned for it. One way to stay tuned for it is to like and follow us on our social media, our Facebook or Instagram, where we post all our latest updates and campaigns from time to time. So remember to like and follow us. It's MQ Trader. And also you can like and follow us on our i3 page to get our latest articles, or download the MQ chat to get the full feature of i3 Investor as well. Once again, congratulations for all winners, and also thank you for all audience who participated in this webinar and also made it a success. So thank you for staying through, and I hope you all have learned something today. I will turn off my camera now, and the webinar will still be live for a few more minutes so that all of you can still refer to the links in the chat box. And for our mysterious gift winner, remember to use the link to send in your contact details, your mailing address for us to send the gifts to you. So once again, thank you. And I'm Casey from MQ Trader. I wish you a great week ahead. Bye-bye.
Thanks for watching.